Welcome everyone. Today, we'll be discussing money mindset, the greatest investing secret. Let's dive in. Here's what we'll cover today. The smartness trap, the importance of behavior, how rationality can backfire, debunking identity myths, and finally, the secret revealed. First, let's explore the smartness trap. Does having a high IQ or elite education guarantee investing success? The truth is, the market often punishes arrogance and rewards humility. Ordinary behavior can often outperform genius-level analysis. Remember, high IQ is not equal to market-beating returns, and elite education is not equal to financial success. Humility, arrogance in investing. It's been proven that novices who buy and hold index funds can consistently beat seasoned professionals. Investing is a game of endurance, not expertise. On one hand, we have the expert who does active trading and pays high fees. Then we have the novice who consistently invests in index funds. And finally, the average Joe who practices dollar-cost averaging. Now, let's move on to behavior over brains. Dollar-cost averaging wins because the mechanical advantage of steady, emotion-free contributions is undeniable. It's the financial equivalent of brushing your teeth, boring, repeatable, and incredibly effective over decades. The key is to invest a fixed amount at regular intervals, which reduces the impact of market volatility and automates discipline, removing emotional decisions. To ignore financial news is to get rich, because daily headlines are noise-engineered to trigger trades and fees. Media abstinence is the compound interest for the mind that protects your long-term plan. While everyone else is concerned about the noise, breaking news, market panic, expert predictions, you should focus on the signal, your personal financial plan, long-term goals, consistent strategy. Psychology is your portfolio. Cognitive biases are the primary cause of portfolio damage. Self-mastery is the ultimate edge, more valuable than any analytical model. Beware of overconfidence, which leads to excessive trading and risk-taking, loss aversion, which causes panic selling during market dips, and herd instinct, which fuels buying high during market bubbles. Let's now discuss rationality can ruin you. Hyper-rational optimization, like selling at the first sign of a recession, can lock in underperformance. Markets reward patience, not perfection. The rational mistake is trying to time the market perfectly, often leading to missing the best recovery days. The irrational win is staying invested, even when it feels wrong, which is the commitment required for long-term gains. Money's true value is freedom. Wealth is not about accumulating digits. It's about the ability to control your time and choices. This shift in motivation, from ego to agency, makes volatility tolerable. Shift your focus from accumulation, the number, to agency, life purpose and control, and freedom, control of your time. Now, let's delve into debunking identity myths. The old ego says, I am a smart stock picker, which leads to overtrading, high fees, and emotional attachment to picks. The new identity is, I am a disciplined, patient investor, which embraces boring humility and a long-term, diversified strategy. Let's debunk some risk myths. The MYTH is that volatility equals risk, believing short-term price swings are the same as permanent loss, or that cash equals safety, thinking cash is risk-free while ignoring inflation erosion. The reality is that risk means missing goals, and that long-term holding of diversified assets is the real path to wealth preservation. Finally, let's reveal the secret revealed. Sustainable investing success is a function of temperament, not intellect. Your behavioral toolkit is your greatest asset. This involves automation, diversification, a media fast, and goal clarity. Stay the course. The secret is your behavior. Thank you.